Hello again, this is FairBinaryOptions.com, and we are moving on with our Binary Options Academy project, looking at one of the most important things when you trade with Elliott waves analysis, and that is the X wave or the intervening X wave or the connecting X wave. Like the name suggests, the X wave is another corrective wave that just connects two different corrections. So, for example, let's assume that you have a trend to the downside, and the trend to the downside goes something like this. This to be wave A, this to be the B wave, and then you have a C wave, something like this. Then you need to have an X wave, and then another corrective wave to the downside, something like A and the B and the C. Now this whole pattern here should be labeled with the following structure in terms of Elliott waves. It should be labeled that this being wave A, this to be the B wave, this to be the C wave, X, and then just another ABC. It is simpler, or it is simply to understand now the nature of the X wave. So basically it is just a wave, mandatory to be a corrective wave, to come and to connect two different corrections. The first correction is this one, ABC. The second correction here is this one, ABC. Like you can see here, X waves are mandatory to come in complex corrective waves, not in simple corrective waves. And again, they are mandatory to be corrective. And then complex corrections are coming with two different types of X waves. A small X wave, like it is this one here, that should retrace less than 61.8 when compared with the whole previous correction. So what you should do is to take the Fibonacci retracement from the highs till the lows here, look for 61.8 retracement, and the X wave is mandatory not to end beyond the 61.8. And if you have, for example, this looks like a double combination. The first correction X wave, second correction, you might even have another X wave and then a triangle or something like that, on a triple combination. The second X wave to come should respect the same rules, in the sense that it should not retrace more than 61.8 when compared with the second correction then. So that is mandatory in an X wave. It should be mentioned that the X wave is going always against the main trend. Now the trend here is to the downside. The X wave goes always against the main trend, but in a corrective fashion. So the X wave can either be a zigzag, can either be a flat, or can be a contracting triangle, as a matter of fact. Therefore, it is important to know that there is no impulsive move, even if price goes aggressively to the upside. Whenever you're looking at a contracting triangle, or whenever you're looking at or an X wave to be formed, it is happening most of the time, or it is having most of the time, the simplest corrective wave possible. It is not a double or a triple combination or a complex corrective form for this X wave, but just a simplest corrective. So you are just looking for a triangle, or another zigzag, or another flat to come there. This is the theory. This is what we should do. And how to trade binary options? Well, normally whenever price is you are looking what kind of a simplest correction you might have here: flat, zigzag, or a contracting triangle. And then let's assume that price still goes to the upside, something like this, threatening the 61.8, but it comes to the 50% area there. That would be a nice place to go and buy put options if price retraces that much. Moving forward, let's go on the second part of this project, and then we'll try to apply what we've discussed on the euro and the Japanese yen part here to see what kind of an X-ray we have there and how to trade binary options based on it. Stay tuned please for the second part. This is fairbinaryoptions.com, and all this analysis and recommendations are possible due to the help of our sponsor, Lioneye.